Well, g'day there, traders and friends, market participants and enthusiasts right around the world, YouTube subscribers, and everybody else watching this analysis video. My name is James. I'm here on behalf of Pivot Point Trading, and today's date is Wednesday, the 15th of June, 2016. Today's video is going to be a market update. It is going to be quite a comprehensive market update. It has been about a month since that last public video I have done on YouTube. I've been waiting for the market more or less to speak on behalf of myself. It looks as though it is beginning to speak, i.e. the true identity of the primary trend is resuming. And it's very interesting as we move further into June and also into the second half of the 2016 trading year. So I really, first of all, I don't have, I guess, a guide on what I'm going to be speaking about. What I will be doing is just recapping the markets. I think I'll start or begin with the Russell 2000. I'll touch on the transportational average, then move back into the three US equity markets. I'll also be probably highlighting one particular stock, which I'm keeping a very close eye on because it has materially broken down below not only its 2009 GFC lows, but also its float dating back to 1995, 1996. That stock is Deutsche Bank, just to let you know. And I think that's showing us some of the problems on the horizon as we move further into the trading year for 2016. So what I'd like to do, before I get into the technical analysis, nonetheless, I'd encourage you to get settled in. First of all, if you want to make yourself perhaps a tea or coffee, I'd encourage you to do so because I will be speaking about a lot over the next 20 to 30 minutes, and it's a good idea to get comfortable just so you can really internalize and materialize a lot of what I have to say on the state of the US financial market. So what I'd like to do is begin, I suppose, with the Russell 2000. I've been keeping a very close eye on this particular market and a chart pattern which seems to be setting up. Very, very nice chart pattern. This is the weekly chart of the Russell 2000. Maybe to put this in context best, maybe I should start with the 2009 lows and where this bull market has stemmed from or began. You can see over here, these are the lows in 2009 when the market's reversed. We've got these three decelerating fan lines, okay? So as we have begun the new bull market in the Russell, this was at the end or at the beginning of 2009 through to where we are currently, you can see these three extensions. These are just the deceleration of, I guess, the acceleration higher in the Russell 2000. What you need to pay attention to is this third fan line. Generally, fan lines, they work in groups of three, and this is also applicable to the other three US financial markets, which have broken below their respective third fan line. But what we have done is we've projected this over since the end, or really the last material touch in 2012. Sure, we came very close in 2014, but as we moved into 2016 and towards the end of 2015, we began to flirt with this area, all right? At the beginning of 2016, when we saw the markets all pull back, they all started to correct. We saw widespread selling across the board. The Russell, once again, like many of the markets, established the first macro lower low. So as you can see, we broke the third decelerating fan line and we established the first macro lower low to begin the year 2016. Fast forward to February, much like the equity markets, and they have been on a rip higher, an absolute tear higher. What is very interesting to note on the Russell 2000 is that we are still yet to put in, again, a new macro higher high. So if we put into context the last swing high, now this was dating back again towards late 2015. Since then, we've posted that lower low and we've rallied back on up on the weekly chart, and we're still yet to break above 1,200. Now, what makes this even more interesting is that here we are at the current juncture, and on top of that, we have this really nice, and in technical terms, sorry to say this word, a beautiful head and shoulders chart topping pattern setting up. You can see over here, we've got the left shoulder. I'm going to label it number 1. We have the left shoulder 2. We have a potential head in 2015, much where the three equity markets, or the widely followed equity markets, the Dow, the S&P, and the Nasdaq, just stagnated sideways before, again, they began to retrace into 2016. And here we are potentially with the first right shoulder. And now what has just formed, all right, since the pullback from last week, is the second shoulder. This is a fairly large chart topping pattern. This dates back really to the beginning of 2014, and the structure alone in this pattern is important to first recognize and to understand what happens next. Since the peak in 2015, where you failed to put in a macro higher high, this is telling us that we are essentially in a bear market on the Russell 2000. If we zoom into the detail, okay, over the past 3 weeks and up at this critical area of resistance, just shy of 1,200, we have what we call an evening star reversal pattern. All right, so we've got a relatively long day white candlestick. We have a doji, what we call a gravestone doji. And then as of the print on Wednesday, here we are, you can see the long body developing, all right? We've still got 2 trading sessions left, but what is important to note is that this pattern showing up at the right location is very bearish for the overall markets, and it is the first signal which we have on the Russell that this head and shoulders chart topping pattern, i.e. the right shoulder, okay, the symmetry of the pattern is starting to form, or at least starting to break down. If we take this one step further again, if I zoom out and show you this, let me just bring up the right indicators here. You can see on the daily time frames, we're getting sell signals. So the Stokes is certainly confirming that move. So is the RSI, and the MACD has just crossed. Now, on a daily time frame, sure, these are important. We as technical swing traders, we want to know where the swing is in terms of the daily movement, but what is most important, what sort of overrides the daily time frame, especially at these critical areas of potential pivot points and what we call inflection points on financial markets, is, well, what is the big picture telling us? Is this just, a little correction in terms of a larger bull market move, or is this the beginning of a larger bearish retracement, i.e. the beginning of a new bear market? So if I go out another fractal, now what I've done simply is, this is the daily time frame, and I've got again the Stokes, the RSI, and the MACD on. If I change to the weekly, have a look at this and ask yourself the question, as we push up into this potential right shoulder, again, the symmetry, the second right, this is what we call a complex head and shoulders chart topping pattern, which has been in effect since the beginning of 2014. Ask yourself the question, is this market overbought or oversold on the weekly time frame? As you can see for yourself, not only are we seeing, again, bearish candlesticks on the weekly patterns and also 3 weekly bearish candlestick patterns setting up, we can also see the Stokes is still very much so overbought, and it is just beginning to correct. The RSI has just turned down, and if you pay attention to the MACD, the histogram line, we've got a couple of weeks now where the histogram line is turning down and it's moving back towards that central point, i.e. that the signal line or the fast line is beginning to turn. What makes this pattern, again, on top of the weekly time frame, even more compelling is that if I change out, and this is what I mean by the macro picture of this market, is that we still have strong sell signals across the board on the monthly time frame. If you pay attention to the moving average convergence divergence, otherwise known as the MACD, this is still strongly negative, although the market has retraced, and this is the intermediate movement back into the declining primary trend. All right, the primary trend is your friend, whether it is that of a bull market or a bear market. And what I mean by primary trend is that when we establish these fan lines, this is the primary trend of the new bull market, or what was the bull market. It is now flipped, and it is now acting as resistance in terms of the new primary bear market. Nonetheless, these are still hard sells, okay? So as we have seen the markets over the past couple of months rally since those February lows, we've been calling it as a bluff, or sort of like a pseudo rally, which is assumed to fail. Well, all of these signals are still bearish. The Stokes is technically crossed, but it's moving absolutely nowhere, it's moving flat, and as the market pushes back down, it's something to keep a very close eye on. So that is something, at least on the Russell, which has been developing. To the naked eye, or at least to the novice eye, it looks as though this market is setting up a new bullish trend. In my opinion, it's a pseudo rally which is set to fail. It seems to be failing even on the back of today's Fed Open Market Committee announcement by Chairwoman Janet Yellen. It still wasn't enough to spook this market higher, nor any of the markets. People were actually selling this on the back of what a lot of bulls were holding in their back pocket, saying that, look, this is going to be, the impetus to push the market higher. The fact is, people sold it. And again, the writing is on the wall in terms of the Russell 2000. You can see the volume again screaming, all right? Screaming in terms of sell side volume. When we had, this parabolic blow off top, when we broke above those late April highs, we were calling it as unsustainable. None of the other markets were in agreement with the Russell 2000. And as you can see, this is most likely that second, all right, the second symmetry of the right shoulder in conjunction with the left, or the two left shoulders over here, and the head, which is set up since 2015. So that is something which I'm keeping a very close eye on, and which is set to roll and continue traction to the downside. If I bring up its cousin in many senses, the Dow Jones Transportational Average, have a look at this chart as well. If I bring up the weekly chart, ask yourself the question, is the Transportational Average putting in high highs and high lows, i.e. Bull market sort of, or a bull market scenario, or the textbook definition of a bull market, or in fact, is it setting up consecutive lower highs and lower lows? And the answer to that question, again, this is earlier into 2015, is that we've peaked, if not in late 2014, and since then, unfortunately, it has been down, down, down. We've been following this quite closely. We've been calling this some form of a double top on the daily time frame. We saw the beginning of a breakdown in early May. We've been calling for a little bit of a back test back up somewhere into this midpoint. That has happened, all right? That is confirmed. And now we're starting to retest these lows on the Dow Jones Transportation Average. If I bring back up the weekly time frame, ask yourself the question, much like the Russell 2000, have we broken out to a new macro swing high, or at least an intermediate swing high? And the answer to that question, unfortunately for the bulls out there, is no, simply we haven't. If I drill back on into the detail, you can see the double top setting up on the weekly chart. You can see this shooting star candlestick dating back 2 weeks ago, where we started to see the reversals across the board on the equity markets. And this week, the Dow Jones Transportation Average, its print as at the close on Wednesday is down very close to 200 points, 195 points. Okay, we're flirting with the intraday sort of entries which I have on the Dow Jones Transportation Average. If this low is taken out over here, now I'll go back into the daily and show you this. Again, this is very easy to see coming. You just have to disconnect yourself from the short-term market noise, which shows up on the daily time frames when you're at such critical turning points. Okay, volatility seems to spike at these turning points because of the uncertainty. But if you let the bigger trend, the primary trend, direct you, it will ultimately result in the continuation of that primary trend. But as you can see, if we break below about 7480, all right, 7,480, I can actually bring up the trigger. Somewhere around here, 7460. Well, then the next area of support on the Dow Jones Transportation Average comes back into the January and February lows. It looks as though we're poised to begin making that move. And the continuation of the bear market in the Dow Jones Transportation Average, much like the Russell 2000, is set to continue. So as you can see, the pseudo rally back up towards, or in between really, halfway through the first half of 2016, it seems to have finished. And now we're starting to price in the new bearish continuation to the downside. If I bring up again the oscillating indicators, look at the daily time frame, you can see the crosses. Again, short-term bearish, that's important for swing traders, right? Again, people such as myself and people I work with. But when we start going up, again, on larger fractals, this is the weekly chart of the Dow Jones Transportation Average. Since we've established that double top on the weekly time frame, it's been sell, sell, sell. Although we've had this little pseudo bounce back up, it has failed, and we are about to continue the downward trend direction on the Dow Jones Transportation Average. The RSI is still, or it has just pushed below that 50 point or that 50 print on the weekly chart. And you can see the MACD. Look at this. I'll zoom in and show you this. Pardon me. Ask yourself the question, what is the MACD doing? It is failing at the neutral point. And since, well, really for the past 3 months, the histogram has been ticking down, ticking down, ticking down. The momentum in this bullish move is exhausted, not only on the daily time frame, but on the weekly time frame. And when I zoom out to the monthly time frame as well, you can see the MACD. When you look at the MACD, when you check monthly charts, the most important indicator of the three is the MACD. It's telling you where the momentum is, and it is still to the downside. So although we have seen upticks on the monthly time frame in terms of the histogram, much like the the Russell 2000, we're starting to see the histogram start to push or at least accelerate back into the true direction of the underlying primary trend. So watch this fast line, the signal line on the MACD, to fall off a cliff very soon on the Dow Jones Transportation Average. The writing is on the wall on these two markets, and it's flowing through into the equity markets. And this is what I want to show you. Now, this is the NASDAQ, okay? This is the NASDAQ really for the best part of late 2015 through to the beginning of 2016. The NASDAQ has never pushed a positive print for the year 2016. So the NASDAQ hasn't actually been in positive territory for the entirety of 2016. And since we've put in these lows in February, where we're calling for the pseudo rally, and then that pseudo rally to fail and then push on back up, that's what happened. I've always been very open to the fact that this area, right, this rough resistance area, this open gap up here, just shy of 5,005, should actually close. Now, in mid-April, we got very close to closing that gap. It didn't eventuate. Instead, it set up what we call an island reversal. This is a very bearish technical pattern. And since then, we've put in some form of short-term lower high. This is the lower high that I've been referring to in previous videos as to where the bulls are going to jump on board and say that, look, this is the the beginning of a new long-term primary bullish trend. And that is, again, a fallacy. It's incorrect. And people buying into this are going to be found out. Fast forward, since this island reversal and since that higher low, which has set up throughout the month of May, we've seen the pseudo rally back up into relative areas of resistance. but we still haven't closed the gap. We got very close to doing it. You can see on my screen now, this has been on my screen since the beginning of 2016, this red box, right? This red rectangular box. Very, very important for the financial markets, or at least the NASDAQ, to come up and close that box. It doesn't have to happen, but generally it does. Now, we got very close to it once again at the beginning of June, but as you can see, we've reversed. This is what we call a Japanese rounding top, and we've pushed away from this area. I am still open, all right? Very much so open, even though macro, okay, I'm bearish, bearish on this market, and with great conviction, I'm still open to the possibility, at least, that the NASDAQ may run back up and not only close this gap, all right, that really kickstarted this bearish move or this most recent wave of selling pressure, but have a parabolic blow off top, much like in the Russell, where it just continues to move up, but ultimately that move fails and it gets reversed, or at least the reversal happens just as fast and writes off more or less all of the gains. So the key levels which I'm paying attention to on the NASDAQ is that, well, in terms of the monthly time frame, and when we start looking at the 10 and the 20 simple moving averages and looking at these big bearish crosses which have taken place a couple of months into the trading year of 2016, we are technically right on those areas on the NASDAQ, but we're looking for the Dow and the S&P to begin pushing below those macro sell signals to validate the bearish move. So as I look at the equity markets and really the NASDAQ, I'm very 50-50 on this market. Short term, we may see, again, a very quick push up to close this gap and then to ultimately close the gap at 5,005. But given, the traders' reaction to the news today, of course, that big fundamental announcement, that possibility or the likelihood of the market staging that rally has diminished somewhat substantially. All right. So I just wanted to update you about that on the NASDAQ. If I zoom out to the weekly time frame, again, ask yourself the question, does this look like a bullish chart to you? Where are the higher highs and where are the higher lows? They're simply not there. All right, if I zoom out and put this in context, again, it looks as though we've got some form of a triple top setting up, or at least a consecutive series of lower highs. It doesn't matter which way you try and break down these markets. The primary trend is what is most important, all right? The primary trend, and that's where we find ourselves at the moment. So on the Dow Jones Industrial Average, between 18,000 and about 17,300, we've been stagnating, moving sideways, much like the S&P 500 as well. But when you start to really drill in, or at least look at the price movements, and to at least start calling or begin calling this market noise, again, trying to shake out shorts and unfortunately try and bring in novice bulls, or at least people trying to buy the market at these levels, expecting that the markets are going to break out. This is ultimately a shakeout, and what it looks to be happening right now on the NASDAQ is that we have a double top setting up. All right, the neckline is formed. That was the lower high, where the last video was released. And this is going to be the neckline for the major market move, right? Or the major market breakdown. If I put this in context of other relative patterns which we have seen in the past, doesn't this look eerily similar to what we've seen in November and December of 2015? And then just the stagnation which we saw towards the end of, or towards the middle of 2015, before we started to see the macro lower lows priced into the market. So very interesting. I wouldn't be buying this market on the NASDAQ. Look at this, the daily time frame, strong sell signals across the board. Oh, and by the way, we've got negative points of multiple points, of negative divergence on the daily and of course the weekly time frames across these markets. There really is too much information to cover in this market update, but it doesn't really matter which fractal you look at this. This is now the weekly chart of the NASDAQ. We're just only starting to get sell signals. You can see the signal line or the fast line on the MACD beginning to turn down. We haven't seen any of the momentum indicators push on back up or support any of these moves. That's why I've been calling it again a pseudo rally, and even calling the pseudo rally itself, but just not simply buying into it and starting to position myself personally as to where I can find the best prices, again, to open up those long-term short positions across the board on the financial markets. Again, this is the weekly time frame on the NASDAQ. If I move out onto the monthly time frame, pay attention to that MACD. You tell me, is that bullish or bearish on the MACD? Very simple question, very simple answer. It isn't a trick whatsoever. Last time we got sell signals on the monthly time frames again have been back both in 2000 and 2007, 2008. That is across the board. These indicators haven't failed, so you cannot sit there and say, well, this is a false signal. It is still a true signal, and even into 2016, it still remains true. We'll just see where it takes us, but we definitely, or at least we haven't materially broken down the bearish case whatsoever. In fact, it is just continuing to strengthen. And the market is giving you the opportunity to place, or at least open up. I'm not telling you to do this by any stretch of the imagination, but it's offering you a pretty enticing price to take out a hedge if you want to do so, right? Because in my humble opinion, I don't think that the S&P 500 is going to hold up around 2,100 for all that much longer. The Dow Jones Industrial Average is going to push away from that 18,000 figure for a very long time, probably a number of years. And again, the NASDAQ, which has been holding up the best of the three US markets. I mean, it's pushing away once again from that 5,000 psychological round number. Even though we're still yet to close it at 5,005, I wouldn't be, if I was a betting person anyway, I wouldn't be betting on the NASDAQ coming up and filling that 5,000 level. We've more or less got there on 2 occasions now, and we simply can't hold it. The market's speaking for itself, and this may be the beginning of that major move which we've been waiting for since this pseudo rally really started, okay? I'm not sure if I haven't covered the Dow, but again, it's a very similar picture to that of the S&P 500. It actually eclipsed or moved above its October and November high marginally, and only for a couple of days. Since then, we've been putting in macro lower highs. Okay, we pushed on above this little May high in the month of June, but that has failed. We're back down into the center of this range-bound area between 18,000 and about 17,400 to 17,300, as I've previously alluded to. It doesn't even really matter. There's people out there at the moment, and for quite some time we've been saying, look, we've got the bullish alignment of the exponential moving averages. And although they're sincere, they're just unfortunately sincerely wrong. When you're in a range-bound market or a stagnant market, you don't want to be paying attention to the exponential moving averages. You want to be paying attention to support and resistance in the structure of the intraday, or at least the daily moves where support and resistance is showing up. Just because you get a cross on the exponential moving averages doesn't signal a legitimate, buy or sell signal. It's largely irrelevant, and the signal itself becomes defunct. But even the bulls out there who are unfortunately not interpreting data, or at least the technical charts, the way that they should be, we're sitting right on the edge of the 50 exponential moving average. The Dow Jones Industrial Average has actually closed down below it again. And the NASDAQ, you can see we've closed below the 50, even though as I'm speaking to you now and positioning myself as I'm sitting next to you, it isn't really a sell signal. For all of those complacent bulls out there who have been calling, these exponential moving crosses back and forth all over the place, you really need to learn how to apply them to financial markets and, of course, individual shares as well. Otherwise, you're going to be caught out. You're going to be whipsawed trying to jump into pseudo-bullish moves and also pseudo-bearish moves, but not taking into consideration the larger picture, all right, what the markets are actually doing long-term, and really trying, or at least what you should be trying to do, is really just to shun, of course, market noise, okay? Market noise is dangerous out there. You need to pay attention to price. Price is key, all right? Price is everything in financial markets. So as you can see right there, that double top, once again, setting up on the NASDAQ, aligning very well with that right shoulder. And again, on the Dow Jones Industrial Average, this is a really ugly head and shoulders chart topping pattern. I wouldn't even call it a head and shoulders chart topping pattern. In context, however, again, it's simply just another peak. Until we break above these respective peaks, I do not understand why people continue to buy this market, or at least expect the market to break out above this resistance area. I mean, I can't even count on both my hands the amount of times this market has rallied up and failed. What's that? 2, 4, 6, 8, 10, 12, 13, multiple times over and over again. I've missed a couple of moves in there, but largely we've just been moving sideways. You can count these little fakes here as well, but the market is failing to break out to new highs. It's just a repeated pattern. And I think the dynamics, I truly believe we're at an inflection point across the board on these financial markets. And the US is generally the last market to begin to price this in. Much of the European markets are already in bear market territory, or they already are in bona fide bear markets. And the US market globally, so to speak, is the only market within X percentage of its recent top. And not so much recent top, but dating back to the 2015 top. So again, the market is giving you, in my opinion, the last opportunity to really position yourself for this coming move. Time will tell, but at the moment, none of the analysis at the moment and for quite some time is telling me that any of this technical picture at least has fundamentally changed, and why we should be looking at this in bullish context. If I bring up, and this is what I was speaking about at the beginning of the video, just to show you this as well. This is the chart, pardon me, of Deutsche Bank. All right, Deutsche Bank, the biggest bank in Europe. It also has one of the biggest derivative books globally out there. This is very interesting because I've been paying attention to Deutsche Bank, and it's been in this symmetrical triangle. I spoke about this over the weekend, and how generally consolidational patterns, if you know your patterns, and especially symmetrical triangles, they break in the direction of the primary trend. Why is this applicable? Not only is Deutsche Bank, breaking to the downside, but there are a lot of individual stocks out there as well, which are in symmetrical triangles, which haven't broken down, which I assume are going to break down over the coming weeks. But moving back into Deutsche Bank, here we are. We're priced at $14.82 per share for Deutsche Bank. We've broken out of this symmetrical triangle. Generally, we will take the first oscillation, all right, within the symmetrical triangle, and that will be the price projection from the breaks. We take the $20 move, and the bottom of this is coming in at about $15. So we can take $15 and then project it from $16.50. That's giving us a price target very close to $11 a share on Deutsche Bank. Since we've broken the symmetrical triangle, we've taken out the May lows, we've taken out the April lows, and we have now just taken out the February lows. To put this in context, okay? To put this in context, you're looking at this chart right now, we've got 1, 2, 3, 4, 5. We've got about 5.5 months of price data. Have a look at this. When I zoom out, I'll move to a line chart just so you can see this. We're zooming out, zooming out, zooming out, zooming out. This is going back to May 2014. This is when the price was up at $42 a share. Going back out to 2010, the price of Deutsche Bank was up at $75 a share. I can't actually get any more data on the daily time frame, so I have to change to the weekly chart. And as you can see, that's just unfortunately, I'll try and move it in a fractal. I think that's the best I can do. But since peaking out in 2007 at about $150 a share, you can see on the right hand side of my screen, it has taken an absolute beating. This is the GFC low in 2008, early 2009 we had it again. The bull market rally, Deutsche Bank didn't really correlate all that well with the other financials. Since then, as you can see, it's been in its bearish trend, and it's at the point now where it's really beginning to get scary for Deutsche Bank. This is the monthly time frame. I just wanted to put this all on one chart for you. I can actually change to the candlestick chart just to show you this. Deutsche Bank floated, you can see towards the end of 96, early 97, where well and truly below those lows. We're not only at 52-week lows, not only at multi-year lows, but I mean, again, this is dating back to 1996. So how many years is that? 20-year lows for the biggest bank in Europe, with the biggest derivative, book list or exposure to the derivatives. So this is telling me that obviously something's up with Deutsche Bank. It isn't really, I mean, from time to time you hear market analysts and strategists talk about some of the woes Deutsche Bank are having. The charts are definitely saying that obviously there's liquidity as solvency issues with Deutsche Bank, although a lot of people aren't or have no idea what's going on. If you bring up a chart, I'm sorry I can't do this for you now, but if you bring up the chart and overlay it with, say, like a pre-Lehman stock price, it is scary, the parallels between these two banks. And if the base falls out of Deutsche Bank from these levels, it may not happen over necessarily the next couple of days, but if you keep an eye on Deutsche Bank over the next couple of weeks and months, if you see this stock price move down towards $10 a share, I think that's really telling us something. And I think it's sort of the backdrop for what may be coming in terms of counterparty risk and what some form of material failure on behalf of Deutsche Bank, what that's going to do for the wider sort of financial system. That is just an assumption on my behalf, but I'm looking for, again, a black swan. Maybe it's Deutsche Bank, maybe it's not, maybe it's something else. But this stock price right now, for whatever reason, is sinking like a rock, and investors and traders simply do not have faith in Deutsche Bank right now. And it's just very interesting to note that obviously this is, or was, I assume it still is, sort of like the bedrock of the European banking system, and it's taking an absolute beating. That is flowing in, of course, to the US financials. If you have a look at Goldman Sachs, for instance, although it's more so of an investment bank, have a look at this, or private equity service, you can see right here, again, it's just materially breaking down below that 148 trigger, which I was speaking about for a number of weeks now. And ask yourself the question, are these stocks in bullish trends? Are any of these stocks, other than Amazon, which has taken a bit of a hit recently, breaking out to 52-week highs or anywhere near their respective highs? Have a look at Apple. Okay. What are they doing? Consecutive lower highs and lower lows. This is the textbook definition of a bearish trend. Boeing Airlines, these are just the stocks we follow. Consecutive lower highs. You've got consecutive weekly candles with upper wicks at those macro areas where we expect the next wave of selling pressure to stem from. Having a look at Baidu, for instance, again, this is one of the symmetrical triangles which I've been speaking about in relation to Deutsche Bank. This is just on a much larger area. What is happening with the stock price? Macro, lower highs. It is across the board. Caterpillar having a pseudo rally since February or early February 2016. What is happening? It is still setting up macro lower highs. Instead, if any of you know how to read a chart, and I say that with humility, but if you know how to read a chart, there is no reason to be buying these shares. You've got shooting stars at resistance areas coinciding with primary bearish trend lines. And again, you're still failing to put in even an intermediate higher high. Have a look at Chevron. Chevron's been doing quite well because of the oil price, but put it in context. Has the most recent swing high broken above the highs of 2015? No, it hasn't. So there's a very good chance that all of these stocks are going to, once again, resume the selling wave. Google most recently looks like Netflix, probably 6 months prior to all of this funkiness. But as you can see, we're moving sideways. We're stagnating at best. Although we haven't seen a material breakdown, I think it's just around the corner on Google as well. I've recapped Goldman Sachs, although I'm not going into the daily time frames and looking at these trades on that level. You have to pay attention to this. IBM, what's it doing? All right, these are the big companies leading the market. The Russell 2000 encompassing 2,000 smaller cap stocks. What is it doing? It's reversing. It's continuing the bearish trend, just as equity markets are up at those all-time highs. And again, on the back of such a fundamental backdrop today in terms of that FOMC announcement where the markets actually sold off. Generally, and in the past, they would have rallied. That wasn't the case, although there was a little bit of indecision. Obviously, with that announcement towards the end of the session, the markets all in unison move to the downside. I think it's something larger, which is around the corner for these equity markets. Tesla, you can't escape reality, okay? You cannot escape reality. I'm just bringing this to your attention because it's something that I'd want to be, at least told of if I didn't have at least the knowledge to make decisions or at least understand what truly is happening. Walgreens Boots and Alliance, if I look at this on the daily time frame, it's gone absolutely parabolic since last week. And it's sort of an anomaly, out there at the moment. But just today on Wednesday, we've been looking for a candlestick to show up post this long day Moribozu. We've got that. It'd be interesting to see what happens with Walgreens Boots and Alliance. What I haven't touched on in this analysis video are the multiple points of negative divergence. There is a lot to speak about, but just to show you this, the Dow Jones Industrial Average, it made these short-term higher highs. We started to diverge away from the MACD, or at least to see that divergence between price and the MACD signal. We've come up once again most recently. We've made a relative high, but look at where the MACD is. It's just nowhere near. There's no momentum behind this move. The stochastics, sorry, not the stochastics, the S&P 500, again, have a look at this. You've just got this multiple, right, points of negative divergence showing up between the MACD. That's on the daily time frame. You go to the weekly time frame, it's there as well. It's a very, very dangerous time to be buying this market. Much like we saw shooting stars, say for instance over here on the Dow, we got a shooting star here just before the big sell-off, and all of these hangman candlesticks, we've got again pseudo sort of shooting stars prior to again the bearish movements. The writing is here. I mean, it's telling us this is the tipping point. So it doesn't matter if you don't agree with me, but if you see these markets begin to crack below the May 2016 lows, and of course people in pro know those macro triggers which I'm paying attention to, well then there's a very high probability and a very high chance that these markets are going to move materially lower, and that the actual structural setup, the transition between, and this is what's most important, the transition between that of a bull market and then the setup and at least the reasoning for at least the beginning of a new bear market, that is complete. All right. And then what will happen is that as price moves lower, more and more of market participants are going to wise up to the simple fact that these markets are moving lower. At that point, that's where you start to see pseudo bounces which go more or less nowhere. They're very flaky, and then the real selling pressure to show up. So this is all, again, a transitory top across the board on the financial markets, and you get these really strong rallies. This most recent rally, which we've seen since February, this is most likely going to be one of those final rallies which we see until the real selling pressure hits these financial markets. So you've got a little bit of information at least to digest. If you found this useful, give it a thumbs up. If you like this type of analysis, I do it every weekend. But from time to time, I will make this public on the YouTube channel. I don't do it all of the time, but when it's needed and when markets at least are turning hard negative, it's good to be informed at least so it doesn't come as any surprise as the markets move materially lower. Now, again, just to finish with on the NASDAQ, it has been relatively the one market which I'm looking at which could still see this gap fill, right? And also this gap fill. So that's sort of the trump card or the joker, so to speak, the wild card where I can see it happening, but believe me, I would not be buying this market. In fact, I would be doing the contrary. I'd be looking to shore up some shorts at these high levels because, in my personal opinion, I think this is the last time that the Dow will be up here around 18,000. I think it's the last time that the S&P 500 will be up here around 2,100 and the NASDAQ around 5,000. If, in fact, we see confirmation below these lows, all right, and we see these markets move hard negative, all right, upon that break and upon the confirmation below these structural levels. So I hope you found that beneficial anyway. I wish you all well. Have a fantastic rest of the trading week and the weeks upcoming. Think about what I've spoken about, what I've gone through in terms of the daily timeframes, the weekly timeframes, the monthly timeframes, because when you see these timeframes in unison, that is when the major moves happen. On top of that unison across the board with the sell signals on the MACD, whether it's the daily, the weekly, or the monthly, or across on the stochastics, which are all firming up negative and crossing down from overbought territory during this pseudo rally to the upside. You need to think about the daily candlesticks. You need to think about those weekly sell signals, right? The shooting stars which we've seen develop. You have to think about the head and shoulders pattern showing up on the Russell 2000. You need to think about the Dow Jones Transportational average, or the indice itself, breaking below that double top right shoulder. All of these markets are suggesting the same thing. It doesn't matter which market you look at, they're just in different stages of the move. The Dow Jones Transportational Average, so the Dow Jones Transportational Average looks the most developed in terms of the next bearish wave, all right, because it's on the precipice of breaking below the neckline. You've got the Russell, which is not too far off behind it in terms of its time frame, okay? And then behind the transportation on the Russell 2000 is the S&P, but you can see what is set up to happen anyway. So, and you've got the Dow, which is there as well, and of course the NASDAQ. So outside of that, you've got the divergences setting up on the weekly and the daily timeframes. The monthly charts are strongly bearish, and the simple fact that these markets continue to set up lower highs and lower lows, it's the writing's on the wall. There's not a whole lot more that I can say. Just because a market stagnates, just because a market moves sideways for 2 or 3 weeks, doesn't discount anything which I've said. Much like it moved sideways for 2 months prior to the sell-off we saw at the beginning of 2016, it's all about understanding structure and understanding what needs to happen, right, technically or structurally, before a larger move can happen. It's sort of like the small talk of the market noise setting up, the structure being built until the big move happens. And you can see the structure setting up from a mile away, and you can expect the market moves, or at least expect certain market moves. It's always hard to project time onto that, but it's becoming clearer and clearer, all right? So having said that, there's a lot more I can speak about, but it's just not something that I'm going to move into on YouTube. Have a fantastic day. Have a fantastic evening. Have a fantastic week. For those of you in pro, I'll see you again over the weekend. I'm not sure when I will, again, bring out another YouTube video. You can sit on this for quite some time. You can ponder it. You can rewatch it. You can see what happens in terms of price. Obviously, since this market update and since my past market updates, it's really powerful because it acts like a video journal. So you can go back and you can see everything which I was saying during these moves. And what you'll note is that I've been spot on across the board. Although I can say that I was looking for instance, the Dow to turn around in this location, it's immaterial because we're seeing the turnaround happen about 600 points above that area. It doesn't break down the fabric of the argument technically of what is set to happen, right? Just because you surpass, a rough estimate of where that next lower low is going to be or that next lower high is going to set up, it doesn't change the narrative of what's happening on the bigger time frame. So I just wanted to say that. This is all, again, just my own humble analysis and what I'm looking at. The fundamentals, or at least price in terms of the market itself, have completely disconnected from true fundamental value. You see these divergences occur at market tops. What also occurs at market tops is volatility, and this has just been a back and forth, sideways moving market, which is set to shake loose. And I'm expecting that the shaking loose part is going to be to the downside, as it has been at the beginning of the previous the beginning of the previous two bear market cycles. So to suggest and to be sitting here looking at this market saying, well, I think this bull market is only just getting started, I think you really need to check yourself, because I think the odds are certainly favoring the end of the bull market. If not, it has already ended, and it ended when we broke below that third decelerating fan line. And now we're just, again, going through the structural sort of setup prior to the next lower low being priced in. And that may be scary if you were scared mid-2015 when we saw the first breakdown, and then maybe you were a little bit rattled by the 2016 sell-off. Well, the likelihood of the next sell-off surpassing these lows are relatively high. And again, people will say, well, you don't know that. How can you be so sure? Nothing's sure in finance, but you have to follow, say, for instance, in technical analysis, what happens next once you see certain signs. Again, it's a strain of behavioral finance, and it's really just understanding the psychology or the sentiment of market participants. And what happens next is people selling to close positions and jumping up on the short side at these historical peaks if the market cannot break above and resume its upward trend. That's the reality of it. We're still at that tipping point. I strongly believe we're at that inflection point, and it's looking that we're setting up again to make that move to the downside. So I don't want to hold you up any longer. I don't want to take up any more of your time. Thanks a lot for watching this. I will see you all in due course. Stay safe out there, and good luck in the financial markets, everybody. All right, I'll see you in due course. All the best. Goodbye.